This is TreppWire Week in Review for week ending March 26th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week in the U.S., about 2.5 million vaccines are being administered per day. More than 25% of the population has received at least one shot. An economic data release shows that the economy is gaining some traction after a cold February. Durable goods and home sales were down last month, but this week's initial job claims number fell below 700,000 for the first time since the pandemic. And Treasury markets have calmed since last week, down to 1.59%. And testifying to the Senate Bank Committee, Fed Chair Powell said that he isn't concerned about the rise in long-term bond yields, saying it reflects optimism about the economy. And I know we're going to talk a little bit about the state of the market today.
It's been a very strange week, in my opinion. The data that you rattled off, Martha, is very bullish in nature. And combine that with the comments from Fed Chair Powell and Treasury Secretary Yellen, you would have thought that this was a combination that would have sent the markets higher. Instead, we're ending the week without a lot of conviction. Think about the last couple of days. Thursday, initial jobless claims, 100,000 less than the prior week and 50,000 less than expectations. Q4 GDP revised slightly higher, yet stocks sell off. On Tuesday, Powell comes out and says, we're not going to taper, inflation is under control. And as you mentioned, Treasury rates have kind of calmed down, and yet the markets sell off on that date as well. So the question is why? Is it rising COVID cases? Is it no one is buying the Fed's story that inflation is under control? I'm not really sure, but I'm walking away from this week thinking that this is a very choppy market and there's not a lot of belief in what Washington is selling right now.
Yeah, I think sometimes there are technical things going on as well. It is the end of the quarter. There's probably a lot of forced selling and rebalancing and other things that have an effect. I'm not an expert in any of that stuff, but I'm always reading about different areas of the market that can move the market that you wouldn't think of. But I just think that we've had this epic run in growth stocks for the last year. And this is just the continuation of the transition to the reopening play.
Well, there has been a great deal of rotation, right? The Dow and more long-term, older, stayed bellwether stocks have done better, and the NASDAQ has sold off several times over the last 2 or 3 weeks. But a lot of that was chalked up to rising interest rates, right? When we saw the 10-year go from 1% to 175, it took a big bite out of the NASDAQ. But now that things have calmed down, you would have thought some of that would have been reversed, but we really haven't seen that. The NASDAQ and tech stocks more broadly have been under pressure all week. So I keep coming back to this notion that nobody's really buying right now the fact that inflation is really under control. And that's what's keeping a lid on stocks at the moment.
Yeah, not when gas has gone from $2.25 to over $3 a gallon in like a couple of months. I just want to say that, when I think of you, Manus, I think of long-term, older, staid bellwether. I think you were kind of describing yourself a little bit there.
I just think weathered.
You're the Dow Jones.
Or pruned.
You're the Dow Jones, I'm the S&P, and Haley's the NASDAQ.
There we go.
Wait a minute.
What does that make
and
Martha?
I'm not going to identify Martha.
What is that? Oh, it's the age thing. That's what it is. I appreciate that, Joe. Powell was questioned on his thoughts on the CRE market, and he did have some comment on that we noted.
Well, isn't it funny that, whenever there's a downturn or a crisis or a recession, the regulators always focus sharply on commercial real estate. I think that's because it makes sense. It's either the largest or the second largest exposure for most banks. And that's like that long bell curve of medium-sized and smaller banks across the country often have a lot of commercial real estate exposure. And if you think about it, of course, we talk about it every week. Commercial real estate is exposed to the broader economy through their tenants and through consumers. So we are seeing actually an uptick in, clients and friends in the banking space calling us up and asking us, hey, we're doing CECL, or we're doing risk management, or we're doing an updated, regulatory report for our regulator who wants to see even more detail into what's going on in our underlying real estate. And then there's also the whole angle of, we've been talking about for a whole year, that on the face, delinquency rates and net charge-offs and non-accrual levels have not increased as much as you would have expected. A lot of that due to the flexibility that the banks have been afforded, but there's definitely still delinquency in there, right? And there's still distress that needs to be worked through for sure. So I think just depends on when that outlet or when that steam is released from the system.
I was talking to somebody at the Fed probably 8 or 9 months ago, and we talked about this very topic, about this CRE exposure at the banks. And I asked the question, why does this keep you up at night? Or what is the specific element of it that keeps you up at night? And the reaction I got was one I didn't really expect, but it really rang true. And the answer was that in many of these secondary and tertiary markets, the community bank, the small institution, is the only game in town. That for this $2 or $3 million office, there is no player, right? It is not going to ever be the bailiwick of the insurance companies. It's too small, and it's kind of off the beaten trail. It's probably too small for CMBS, which tends to have loans which are more like in that $10 to $20 million range. So CMBS would take it, but they're not actively looking for it. And then for guys that provide transition capital, it's not big enough for them to make any real money on, right? They want bigger assets to do this. So when you look at a $3 million office, perhaps something that's, has a bank in the lobby and maybe 2 floors of, law offices or accounting offices, that is the domain of the community bank. And if the community bank isn't there to support this, then commercial real estate gets messy very quickly. And that was one of the explanations I heard at the time. So kind of an interesting point of view.
In the CRE space, investors have been waiting for distressed asset sales, and it seems that in the hotel space, opportunities are paralleling the rise in occupancy and people's general comfort in the safety of travel over the last several weeks. So what does that look like?
Well, let me start by saying, Don Sheets, call your office. Your time has come. We've been talking about this for a year. When was the logjam going to break? It seems like it's breaking now. We noticed the other day on 10X, there are 21 hotels or hotel loans that are up for sale on their April 5th to 7th auction. I believe that's the highest number we've seen thus far. And it's indicative, it would appear that those brokering these assets believe that they're starting to see a firming up of pricing. You wouldn't be putting these out for bid if you still thought the bid was going to be very soft. A rough estimate is that half of these are CMBS assets, either REO or loans, which means that other portfolio lenders are also getting into the game now, right? Other portfolio lenders are now looking to move their assets. So we would recommend that you take a look at that 10X website for some of the things coming up. They tend to be smaller hotels. I would call them probably things that will sell in the $5 to $15 million range. Several of the assets come from a CMBS loan. It's called the K Hospitality Portfolio Loan. That's an $86 million floating rate note, which was securitized in 2014. The loan is reaching its maturity date in August. It was structured with a 2-year term and 5 12-month extension options, the last of which has been utilized. So there it looks like the borrower is trying to sell these assets ahead of having to refinance this loan to pay down some of the debt. There were 20 properties behind this loan and securitization. It's been a really strong performer, even though occupancy fell from 77% to 59%. DSCR held up at almost 2x over the last year, which is really quite impressive. Most of the hotels are in Texas, with a sprinkling in California, Oklahoma, and Louisiana. And if you ping Haley, who's behind the glass, we're happy to share our loan report for this portfolio with you so you can see what's behind some of these 10X assets out for auction.
We've been talking about when is the logjam going to break for like 6 months, right? And we've had tons of investors enter the market looking for potential distress. And Don Sheets talked about how he'd seen not nearly as much activity as he would have expected given everything going on. So maybe this is it. Maybe they were holding out for, things to look a little bit better on the macro front to try and get a slightly better recovery on some of these deals that are still distressed.
Yeah, I totally agree. I think that, they're trying to strike now when the iron may not be hot, but it's certainly a lot warmer than it was in October. So I think that has a lot to do with it. Even for those people that are not into buying distressed assets or assets at auction, this is an interesting site to watch because they do give you a sense of what bids are on properties that you may own if you're a property owner. And it may give you a sense of, what kind of value, what kind of equity you have in your own properties currently in this difficult time.
I think in the marketing materials behind all of these sales, they should have the video of that guy in Miami that had the full Joker face mask paint on top of the car screaming, "COVID is over, baby. COVID is over." Like that should be in the marketing materials for all hotel loans sales right now.
Steel City Dave pinged me. He told me that he's down in Florida this week. And I thought, could that possibly be Steel City Dave on top of the hood of that car?
Likely,
I don't know.
actually.
It's possible. So a couple of other things that moved this week. Hawkeye Hotels made its second and third acquisitions of the year. These being hotels in Ohio and Oklahoma. The Fairfield Inn and Suites in Cambridge, Ohio, and Aloft, Oklahoma City hotel. The price was not disclosed. Another story from Hospitality Net. I love this one. Seoul Community Planet, SCP, announced it had purchased the 138-room Hilo Seaside Hotel in Hawaii. And, of course, Hilo. I mean, my pronunciation, whether it's people's names or geography or anything.
That's always bad. We know that.
I only know that because I was there on my honeymoon.
Nice.
It's it has been sold, and we know that just like Las Vegas, Hawaii has just been battered by the tourism fall off. So seeing a deal get done there is just terrific. One other development we're looking at, we thought this was very interesting. This is the subject of a TreppWire story that will be going out Friday morning. The Sheraton Grand Nashville Downtown Hotel has an interesting development going on. A contract has been signed for the sale of the property. It is a 482-key full-service hotel in Nashville, not all that far from where they had the big explosion around the holidays. If you remember, there was I believe, an AT&T building that was bombed. It has a signed contract for sale. However, if the sale falls through, the special servicer is already in possession of a deed in lieu agreement and a transition of the property document that will transition the asset back to the lender. So it's a stipulated receivership, deed in lieu documents. They're in escrow. So this is something we'll be watching closely. If the property sells, the loan gets assumed, the loan cures, and everybody's happy. And this is a big loan. It's a $160 million loan. If the sale goes through, this goes right towards deed in lieu and becomes REO. So it's very binary, something to watch very carefully, and something you don't see very often.
Yeah, and we've started to see a lot of the loans that got forbearance agreements come out of those forbearance periods, and some of them are actually asking for more at this point. So there was one, the JW Marriott in Chicago. It's a 610-key full-service hotel. The borrower had been granted 2 forbearance or relief packages where debt service payments were paused. These weren't even, I don't believe that these were FF&E type reserve taps. This was just a straight up kind of modification where payments were paused. And now apparently, according to commentary, the borrower is requesting a third time out in payment, which they're considering at this point.
So these are positive developments. Nashville, even though it's very much a situation in flux, the fact that it has a bid is terrific. And if somebody's going to assume a $160 million loan, that's a sign of faith. And, with the JW Marriott Chicago loan, what you're talking about there is a situation where a special servicer wouldn't be granting this relief twice if they didn't believe the property had a bright future. So, looking at the glass half full, these, just like the property sales that we mentioned before, these are positive developments for a market that's been battered.
And a borrower probably wouldn't be continuing to ask for relief if they saw no future in sight, right?
Absolutely.
So there was another one. Actually, this is not so great. This is, I guess, glass half empty. But we have another Houston hotel going deed in lieu, the $23.4 million Crown Plaza Hotel, Houston River Oaks. The borrowers requested a deed in lieu. It's backed by a 354-key full-service hotel in Houston. We keep saying full service. I think that might be a theme here. Full-service hotel in Houston. It was built in '83. The borrower had made discounted payoff offers of $11 and $13 million on the $23.4 million loan, but apparently those were denied. It's been in special servicing since July, and the last payment was made in September. So DSCR has been below 1.0 even before COVID. So, this is that Houston story that we've been talking about for a long time. We haven't gotten an updated appraisal. Their appraisal as of securitization was $37 million. I assume it's decently lower than that at this point.
The takeaway for this particular loan, aside from the fact that Houston is a disaster, right? This might be the 12th loan that we've seen go deed in lieu or property go deed in lieu over the last year. In this particular case, if you're owning the bond that has this loan in it, you got to value this thing at $13 million, right? Even though that most recent appraisal was $37 million and there hasn't been a new one, you got to assume that this is a $10 million loss waiting to happen if you're looking to trade any kind of credit bond in that deal.
And one more story regarding hotels. We've seen some back and forth discussions here in New York about tax relief for the hotels.
Yeah, this was a story where the hotel organizations are seeking to lower the amount of interest that they have to pay on back taxes. Is that the gist, Martha?
That is the gist. The gist is obviously
18%.
Yeah, with lower income, obviously their property tax bills are mounting with an interest of 18%.
Well, let me put on my cynical hat here for a second and say the government will never not collect the taxes that it's owed. I'd be very, very surprised if they gave them any sort of relief on the tax side. They might give them like some stimulus money, but I very much doubt they'll change the tax rules.
Turning to office, which is very much in a state of flux. What are some of the stories we're tracking there?
It's an interesting one there that I think everybody's really trying to get their arms around what the new normal is. I hate bringing up that term again because we bring it up every week. Last week, we mentioned that Fitch said office values could be pounded if work from home becomes sticky, and work from home means at least 2 days a week for most businesses. There were mixed messages coming out of the various big banks this week. Morgan Stanley said they're going back in full. They stuck their chest out and beat it hard and said, we're coming into New York and we're doing it. On the other side of the coin, it was Citibank saying they're going to the hybrid model, that they're going to go 2 or 3 days a week, and they're going to look back and try to ratchet things down of the number of people to come back into the major U.S. cities. So I think it's a real challenge for investors right now to get a sense of what the value is for offices, what the new normal will be, if Morgan Stanley will be able to get their employees back and sustain this, or if Citibank will be able to find that they can keep up these efficiency gains that many have claimed over the last 12 months, or if whether they're going to have to abandon that at some point. I think it's very, very hard to know.
I think they have to, if they're going to make us all work from home for the rest of our lives at the pace that we've been going. And I don't work nearly as hard as those Goldman analysts that were complaining about their 100-hour work weeks, but like I bring it up all the time. There's a psychological element here, which is that it's just not natural for us to sit in a room by ourselves for 10 hours a day looking at a screen. It's not natural for us to sit in an office for 10 hours a day looking at a screen either, but at least we can walk around and interact with other human beings other than like the two people that live in your house. So there's something there. Like if we're going to have to do this forever, like you're going to need to send like, a therapist to my house or something to like, fix all the trauma that you're inflicting on me right now.
On the Goldman thing, my first reaction is one of utter surprise. What did these Goldman analysts think that they were getting into? I mean, for 40 years, right, really since the advent of securitization and the PC and model building and everything else, the trade has been, you get paid twice what, or maybe more, 2.5 times what entry-level people get paid for at accounting firms or other industries, and you work 2 jobs. You work 80 hours or more for that money. So a little bit of me is a little bit of a surprise that how did you think that when you got this offer, this was not going to be standard operating procedure for you? Separately, it does remind me, I was nostalgic about this, believe it or not. Who could be nostalgic about working 80 hours a week? But it reminded me of when we were building the CMBS business back in the 1990s. BlackRock had taken a big equity stake in the firm and had asked us to transform ourselves really into a CRE shop. Before that, we did a lot of asset-backed modeling and tax-exempt bond modeling and so forth. And BlackRock said that the market was really illiquid and short on models and trading tools. And they came in and they said, we're going to work you like dogs, but it's going to be worth it. And we're going to pay you more. And you guys are going to become the state-of-the-art player in the CRE modeling business. And I like to say they taught us how to win. And the hours were long. We didn't do 100 hours like Goldman did, but we did do 80. It was usually 9 a.m. to 11 p.m. or 1 a.m. We'd all eat pizza in a big conference room, and it was like we were a family. And I was really glad that this Goldman memo wasn't around back then, because I don't know how we would have gotten through those days.
So I kind of agree with you. Like, didn't you know what you were getting into? But I'll play devil's advocate here as the snowflake millennial, representing the snowflake millennials. I think that some of the complaints are that a lot of those hours and a lot of that work is more of like a hazing than anything else. Like that there's a lot of it that's like
allegedly,
right, that a lot of it is like, hey, these MDs and associates are just treating us like this because that's the way they were treated. And like nowadays, with efficiency of technology and efficiency of like even like Microsoft 365 and all this other stuff, like it really shouldn't take us 650 turns of a PowerPoint deck, to get to a final state. And a lot of it is just kind of, I think that a lot of it is, this is the way it's always been done. And there's feeling like we could probably get this work done in 70 hours, but we're just doing 100-hour weeks because that's what we're expected to do.
And now you see Citi having Zoom free Friday and Citi Day as a reset day. So maybe they're coming around.
I'll throw out one more anecdote, which I thought was great from back in our days when we were building the business. The guys that were working for us, the young analysts, they took amazing pride in building the best models, making them as robust as possible, and getting them out there as fast as anybody. We had real competition back then. We kind of won the day, but it wasn't easy. But we made an error in 1998, and we had a client. I'll call him JB, and he pointed it out to us, and we were so mortified by this that we vowed that this would never ever happen again. So much so that some of these analysts tried to learn Perl over the weekend to fix the code that this was written in. But by noon on Saturday, they realized that was impossible. So we brought this guy in, Hall, who was the programmer at the time, and he agreed to work over the weekend to fix this problem, only if we let him smoke at his desk and we pumped him with Diet Cokes for the next 40 hours, at which point he only got up for bathroom breaks. And at the end, we had to bring him to the bar to feed him beer and deviled eggs, which is kind of an anecdote I was thinking about, comparing our life back in 1998 to Goldman in 2021.
We've come farther, thankfully.
There was no smoking, at least, and you'll never see me touching a deviled egg
With beer.
with beer.
So we had a number of other stories.
Yeah, so some of the negative stories, concerning stories that we've been watching, we're seeing a lot of signs in special servicer notes or news stories where tenants are vacating properties. Johns Hopkins leaving a Maryland office, CBRE putting 60,000 square feet of sublet space in Dallas out. That's at 2100 Ross, and that lease is over in 2022. So that's a concern that if they don't find somebody to sublet it quickly, it'll sit vacant for a while. Q2 Software in Austin, Deutsche Bank has given back sizable portions of space in Jacksonville. Facebook walked away from a deal in Austin. They were expected to take 350,000 square feet at 300 Colorado Street. They were originally supposed to take 1 million square feet in Austin. So I don't know if this walking away from Colorado Street is deal specific or shows a smaller commitment to Austin, Texas. We've shown other tenants in Greenville, South Carolina, Mountain View, California, Brewster, New York, home of a great beer league hockey setup, Bellevue, Washington, also giving up space, and Canadian Pacific Railway noting it's going to move its headquarters from Minneapolis to Kansas City after its $25 billion merger with Kansas City Southern. That comes after Target announced it would be relinquishing tons of space in the Twin Cities. So a lot of negatives there, things that concern us about so much space hitting the market. There are some positive developments, though. Here are a couple. Blackstone just purchased 2 properties from Shorenstein for $230 million in Miami. Those would be 2 and 3 Miami Central. So Southern Florida, Southeastern Florida continues to really pile up the victories in terms of getting new tenants and new development taking place. The Petrinelli Group landed its first tenant at a Denver tower under development. It's doing that with USAA Real Estate as a partner. They signed law firm Sherman and Howard for 60,000 square feet. So congratulations there. And lastly, the Financial Times reported that Google is looking to spend $7 billion on offices and data centers around the US. God bless them.
I got to give a shout out to my buddy Sean, who actually continues to listen to the podcast, even though he doesn't work in this industry. So shout out to him. But he had texted me the other day and said, some cryptic message like, CRE must be happy about Google. And I kind of shook for a second, like, oh my God, is Google doing some sort of commercial real estate data product, which would have made me a little bit worried. But he was talking about this actual story where they've already kind of committed to expanding office and data center footprints. So thank God for the big tech names who continue to take up space.
It is a mixed bag though, right? We talked about Facebook. We've talked about Twitter before out in the West Coast, Dropbox, Salesforce. Google is the one, and Amazon as well, that are really keeping their foot on the gas. The rest of them, either there's a commitment to less or it remains up in the air. So back to our original theme, which is the story really remains to be written. We just don't know.
Let's turn to multifamily. We're still watching New York City. So let's look at that.
Yeah, I mean, that's really, we talk about the various markets that what are the big areas of concern, right? In the hotel space, we've mentioned this before, New York, Chicago, Portland, Houston, in the office space, San Francisco, Seattle, Minneapolis, New York. In the multifamily space, everything seems to be holding up really well, except for New York City. We've spoken about this, that we've seen big drops in occupancy in Manhattan, really across multiple different parts of the city, Midtown West, the financial district. We've also seen it in Queens with some big drops in Long Island City occupancy. We're talking about developments with 800 or more units that have seen occupancy go from 95% maybe into the 60s. So the downturn is really meaningful. Sometimes they have mezz loans on them. So certainly a really soft part of the market. This month, we saw the biggest, I believe, multifamily delinquency in that market. The loan is known as the Yorkshire and Lexington Towers note. It went 30 days delinquent this month. Its debt package, which was originated in 2017, is made up of a $200 million senior note, a $200 million B note, and $150 million in mezz debt. The collateral is made up of two Upper East Side apartment buildings totaling 827 units. They were built in the 1960s, renovated in 2017. The properties were valued at almost $900 million in 2017. Really no risk to the senior loan. The LTV is 22 for the senior note. But when you add in all the mezz loans, LTV gets up into the 60s. No reason was given for the delinquency, but occupancy has dropped from 95% in 2019 to 82% as of September 2020. We don't have year-end financials yet, but we'll be looking at that one closely.
I feel like that 80% number we've seen across several big multifamily properties in New York City, right?
Yeah, I mean, or worse.
Yeah.
It's a big issue. The Gary building down in the financial district, I think we saw that go into the 70s. And those 3 or 4 big Long Island City projects, I believe one of those has 1,800 units. And we've seen those go below 75, or in one case, I believe below 70. So that is one area where that work from a home model, if the city model prevails over the Morgan Stanley model, you really want to keep an eye on those.
And turning to retail, malls are still a big area of concern, even as other businesses open.
Yeah, I mean, there's been no real improvement. The best you could say about that part of the market is that valuations have stopped falling, at least for the time being. We did a segment on this last week talking about how some of the latest valuations have come in at or above the loan balance, which is hopeful. But at this point, of the myriad CMBX 6 and CMBX 7 malls backing big loans, only about 10 or 15% have been revalued at this point. So that was a modest green shoot, but the story, as with office, remains to be written. Some other stories we're watching this week, some tongue-in-cheek, some concerning, some just the status of the market. Washington Prime, the owners of about 100 malls in the US, announced this week that it has worked with Guggenheim to line up with prospective lenders $150 million in debtor in possession financing. Basically, that would turn the equity of the company over to a lending group. The stock price was in the $2 range, 2.5, something like that. Before this report came out from Bloomberg, it sent the stock down 12% after that Bloomberg report came out. So it looks like that Washington Prime bankruptcy filing that we've been speculating about for some time is one step closer to happening. As we know, when these things take place, there is that opportunity for more malls to go jingle mail, for the borrower to give back the malls as collateral. We'll see if that happens with Washington Prime. On the REIT front also, CBL announced that it had entered into an amended and restated restructuring support agreement with its credit facility lenders and unsecured note holders. So it is one step closer to coming out of bankruptcy. We'll see if there are more givebacks as a result of this. We did see a 10x auction of an Alabama community shopping center, as with that Prim Las Vegas auction that we saw a month or so ago, the top bid was disappointing. Not nearly as disappointing as the Las Vegas area one was, but this one came in at about 20% of the collateral value at securitization and about 65% of the most recent value posted in the servicer data. So that was disappointing. And lastly, in a tongue-in-cheek piece, the Press of Atlantic City was reporting that Atlantic City Electric had posted notice that it was turning off the electricity at the Hamilton Mall down in southern New Jersey if the electricity bill wasn't paid on or around April 7th. We think that that's an administrative snafu, not something meaning the mall itself will be shuttered.
Well, we did have one more retail story, which I have to give our friend Donut Shorts a shout out again. He had pinged me last week about a note from Fitch, actually, who had updated some, or I should say downgraded some bond ratings on a 2016 CMBS deal due to their updated expected losses for a Simon property portfolio loan. This is the Simon Premium Outlets loan. It is about $100 million. It's spread across a couple of different, I think 3 different CMBS deals. And it's backed by 3 outlet malls that Simon owns, one in South Carolina, one in Georgia, I think one in Massachusetts. And the gist of it was that Fitch had updated their valuation on this property and applied a 25% cap rate to come up with that valuation. And they were expecting as much as 50% loss on this loan in their alternative loss scenario, which might be a little bit more of a downturn. It was a little bit confusing because there are 2 loans called Simon Premium Outlets. One is on these 3 properties, and there's another one on a separate 2-property portfolio. And that loan is actually 90 days delinquent right now. So I don't think that they're connected in any way other than that they're both owned by Simon, but it just goes to show you those 2, one is in Maryland and one is in California, much more lockdown type states. So it goes to show you kind of Simon's understanding of the future of some of these malls.
Just to take a digression, which I like to do from time to time, did you see the story of that tanker getting stuck in the Suez Canal?
Yeah, of
I
course.
think everybody has.
That's why I haven't gotten my my toilet paper and my soap from Amazon.
You won't be getting it anytime soon.
Well, my first reaction to that was it reminded me of that scene in Austin Powers where he's trying to turn around the golf cart like 1 inch at a time going back and forth. And I'm thinking, how are they going to get this doggone, tanker out of the Suez Canal that is both beached and, turned in the wrong direction? But then my next reaction was, I said, what am I not going to get? Like you were saying, Joe, toilet paper. So I went on Wikipedia, which is never wrong. And I went to the list of exports that are coming to China. Now, this is an older list. It's from 2012. And listen to this. It's from the Observatory of Economic Complexity. That's who produced this list. But anyway, I went right down the list and I said, what are these things on this list am I going to miss? And some of the things are computers, and that could be a problem if my laptop
chips.
ever goes, or a telephone if my iPhone ever drops. But here are some things that I'm not going to miss in the short term. Knit sweaters, number 10 on the list. Non-knit women's suits, number 15. Rubber footwear.
That's a crock right there.
That's 20.
It's a crock of something.
That's
But I'd have to say that the only thing that would cause anxiety in my home, and not for me, would be a video game parts, number 24. That could cause a real spike in the need for mental health professionals among millennials.
Yeah, if anyone doesn't know, when Manis finishes recording, he goes and absolutely pwns noobs on Call of Duty. So you gotta go find him out there.
I play Pong.
Yeah, the one line with the dot going back and forth. So one last story, which has a little bit of an educational bent. We saw that landlords have been offering percentage rent leases where retailers could pay a portion of their sales instead of their fixed monthly amount. But there's some disagreement about how to do that.
Yeah, there's a Wall Street Journal article talking about this, especially now, given that, brick and mortar retailers prospects are not so sure. Landlords are offering them some flexibility. They've always done this in the past, but it's happening more and more. They're offering them some flexibility and offering them more in percentage rent as opposed to a fixed lease. But the problem, and that basically means that the landlord gets some percentage of sales done at that store. The problem is that there's all sorts of negotiation and confusion and discussion about what is a sale at a brick and mortar store, right? So if I come into the store, pick something out, try something on, and then order it online, like, should that count as a sale for that store? The landlord would argue yes, the retailer would argue no. If I'm a retailer and I open up a store in a specific area, and then a bunch of people in that area order stuff online because maybe they came to my store or they've just seen the sign or whatever, like, the landlord would argue that you've influenced the sale with this brick and mortar store, and therefore they should get a piece of it. So I see, like, there's definitely a software angle here where, like, there's probably some solution to this problem that they haven't figured out yet that could be solved with some software.
That reminds me of the 1974 Billy Preston single, "Nothing from nothing leaves nothing." Right. If you have an empty store and no sales, it's hard to get any percentage out of that.
And turning to the deal of the week.
Oh, let me go for my deal of the week. I'm bringing back up my notes. Here we go. This is from Real Estate Business Online. We've been really trashing Houston on several fronts over the last several months, both on the hotel side and periodically on the office side, where we've seen some sizable vacancies and big loan defaults for that reason. In this case, Axiom Space, a locally based developer of space infrastructure, signed a 32,000 square foot expansion at 1290 Hercules Avenue. It adds to a previous footprint of about 64,000 square feet. The expansion brings the property to 100% occupancy. It's near the Johnson Space Center in Houston. Matthew Seliger, Doug Little, and Lou Ann Pereira of Transwestern represented the owner of the building. That would be Capital Commercial Investments, Inc. And again, congratulations to all those involved. And thank you, Real Estate Business Online, for the heads up.
And shout outs. We had a number of interesting shout outs. We had a Money on the Move YouTube clip that actually included a pretty good segment of Manis speaking on his opinions of the state of the market with some interesting video editing there. Jeffrey C., who was interested in the Don Sheets interview that we did a couple weeks ago, a lot of popularity around that particular guest pod. John S. gave a lot of nice complimentary notes to both Manis and Joe. He said he loves the combination of knowledge and humor on the pod, so appreciated that. Megan A. listens to the podcast every week, always finds it beneficial. And we mentioned Donut Shorts, who's on Twitter and comments.
Donut Shorts told me that he is a real person, by the way, just to let you all know. He wanted to assure me that he is a real person.
It's only an alias, Twitter alias. Mark T., he listens to the podcast and says that he actually had a nice thing to say about me. So I really appreciated his commentary where he thanked me for keeping us organized and moving. And as you've heard with all the digressions and meanderings we often have, that's no small feat. Dan McNamara tweeted at us. And by the way, he was the first former guest to notice the comment that Joe made about the best guest pod. And I kind of guessed Dan might do that. So shout out to Dan. John S., the podcast is great, and complimented the Don Sheets podcast. If you haven't listened to it, it was probably one of our more popular calls to action that we've had. Exactly a year ago, claims went from 3.3 million for unemployment, initial unemployment claims, to 6.9 million a week later, as companies laid off workers amid the rash of government shutdowns and lockdowns in the country. And that was when we kind of thought there's a lot happening in our industry and in the economy at large. And the TreppWire podcast was born exactly a year ago, March 26th. Haley put together some stats for us. We've had 71 episodes, 19 guest pods, thousands of listeners, hundreds of shout outs, many of them very entertaining, and we've shared them with all of you. So I want to say thank you for staying with us on this journey. And I know we probably have a couple comments from Joe and Manis, and I just want to thank our listeners for being so appreciative of the value and the humor that we share every week.
Yeah, I'm really humbled by the number of listeners we've had, stunned really by just how many replies we get each week. I have to say, I'm grateful for all the people that reach out to us. I think I've learned as much from the people that come to us with their comments and their thoughts as I think that I've given to other people, which makes this such a benefit for me. I'm really grateful for giving a throwback to Keegan, who was original art producer, to Haley, who works behind the scenes tirelessly to take out the director's cuts, and to Joe and Martha, who do just such a great job keeping this thing going and keeping me from looking like an idiot.
So I was talking to my father-in-law a week or two ago, and we were talking about, I had just finished recording, and I was over there for dinner or something, and I was talking about the podcast and talking about, like, you know, all the listeners and all the great feedback we get and all this other stuff. And he goes, why do you do that? I'm like, what do you mean? Why do I do that? It's like, it's good. It's like a good thing for the, and he had thought this entire year, he had thought that we were just doing this on the side for fun, you know?
Well, we kind of are.
Well, we are doing this on the side for fun. It is under the auspices of Trepp. I will say, you know, nearing 200,000 total listens, like thousands of listeners every week, 20 to 30 people just come emailing us out of the blue and giving us good insight and giving us feedback. And I mean, it's just been so much fun. And it's probably the most fun thing that I've done at work in a really, well, maybe ever, but definitely in a really long time.
And don't forget the golf invites.
Oh, and the golf, we've gotten some golf invites, which we have to take people up on.
I'm going to have to follow along.
But, you know, I think when you're in the day-to-day, just kind of grinding it out, you don't really take a moment to step back and really think about kind of everything that you do and everything that all the different people that are involved in what you do at work. And Haley putting together all these stats and numbers, we got to put like an infographic on it or something out, just so that like those original award-winning listeners understand, you know, they're a part of something larger. I guess I'm just really grateful for you guys, right? Martha, Manis, Haley, and Keegan. I couldn't do this every week. I filled in for Manis for 2 weeks, and I like had to take a nap for like 3 days after that. So thank God for him. I'm just here for comic relief.
So with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you as always for listening, and stay well.
All right.